Welcome, and thank you for joining us. The topic of our webinar today is Hot Topics and Continuous Disclosure for Non-Investment Fund Reporting Issuers. My name is Ray, and I will be presenting today along with my colleagues Yan, Katie, and Tammy. Katie, Tammy, and I are accountants in the Corporate Finance branch at the OSC. Yan is legal counsel in the Corporate Finance branch. We'll be sending evaluation forms at the end of the session, and we'd appreciate your feedback on this format. We'll be sending CPD certificates via email after the session as well. Before we begin, I'd like to remind participants that the views expressed in this presentation are the personal views of the presenting staff and do not necessarily represent the views of the Commission or other Commission staff. The presentation is provided for general information purposes only and does not constitute legal or accounting advice. Information has been summarized and paraphrased for presentation purposes, and the examples have been provided for illustration purposes only. Responsibility for making sufficient and appropriate disclosure and complying with applicable securities laws remains with the company. Information in this presentation reflects securities laws and other relevant standards that are in effect as of the date of this presentation. The contents of this presentation should not be modified without the express written permission of the presenters. We have a number of topics to cover today as outlined in this chart. We'll be sharing our observations on MD&A, venture issuer regulation, materiality, social media, women on boards, and provide some reminders on the annual filing deadlines. We have reserved some time for questions at the end of this presentation. You can submit questions at any time using the chat function in the webinar. However, please note that we will be responding to all questions at the end of the presentation. The objective of the OSC SME Institute is to support SMEs in facilitating cost-effective compliance through issuer outreach and education. It is important for issuers to know the requirements and to help them navigate regulatory waters. The idea is that if we can help issuers to better understand the disclosure requirements, they can focus their resources on building their company. Ultimately, we both have the same goal: for issuers to provide appropriate and meaningful information to investors. It is important to remember that at the end of the day, investor confidence in the information that companies provide is critical to the success of the company. The first topic that we wanted to address today is the common areas of weakness that we see in management's discussion and analysis, or MD&A, filed by small and medium enterprises. MD&As should be meaningful to investors. As preparers and advisors, you can help add value to readers by ensuring that the MD&A complements the financial statements, provides balanced reporting, and is updated for new events. The MD&A can complement the financial statements by providing insight into the financial information rather than just repeating numbers from the financial statements. It should explain changes, lack of expected changes, and the company's progress towards milestones. It should explain the reasons behind the numbers in the financial statements. The MD&A should provide balanced reporting by addressing the bad news as well as the good. Management can earn credibility in the eyes of investors when it acknowledges things that have gone wrong and demonstrates a plan to rectify or respond. The MD&A should be updated for new events by clearly indicating what progress has been made in the period covered by the MD&A. If you were to take MD&As for two periods side by side, it should be clear that there are changes other than the date at the top. In terms of general considerations, the MD&A should focus on material information and discuss important trends in the financial statements, explaining why balances have changed from period to period. Information may be considered material if it would affect the decision of a reasonable investor to buy, sell, or hold securities of the company. The MD&A should explain the reasons behind the numbers in the financial statements. Explaining the why will help your investors understand the reasons underlying the issuer's performance. The balances presented in the MD&A should reconcile to the financial statements. It is very confusing otherwise. It may not be apparent whether the difference is due to an error or an attempt to be less transparent about true performance. If you have a mineral project or an oil and gas project, you should ensure that your disclosure reconciles with any technical reports that have been filed and that technical disclosure complies with National Instrument 43-101 and National Instrument 51-101, whichever may apply. Finally, the MD&A should be written in plain language so that investors understand it as quickly, easily, and completely as possible. You should avoid verbose, convoluted language and technical jargon. This slide shows some common areas of deficiencies that we see in MD&As. I will highlight some of the deficiencies we typically know around discussion of operations and liquidity and capital resources. The first area of the MD&A that I want to talk about today is discussion of operations. In this section, the company should provide an in-depth analysis of the company's operations for the period, including a discussion of total revenue, cost of sales, and gross profit, and describe significant factors that have caused changes in these amounts. A key point to note is that simply repeating variances that can be calculated from the financial statements does not help investors understand trends. The company should explain the reasons that these changes have occurred. Over the next few slides, I'll go over some examples that may highlight ways to improve the discussion of operations. The next area I'd like to address is the discussion of operations for issuers with revenue. This is one area where we sometimes see issuers simply repeat figures from the financial statements. In certain cases, we see issuers disclose that the revenue was X dollars this year compared to Y dollars last year. In other cases, the reasons driving the growth are not thoroughly or well explained. For example, the issuer may attribute the increase in revenue solely to entering production without any further analysis. We believe that a more fulsome analysis is necessary for investors to understand how key factors impact revenue. The MD&A form requires an analysis of amounts changed by selling prices, quantities, or the introduction of new products and services. This is an example of disclosure that we often see in the MD&A for issuers with revenue.
The company reported revenue of $7.6 million for the year ended December 31st, 2016, compared with $7 million a year earlier, an increase of 9%. The growth is mainly due to the sale of X products.
Here, the disclosure is boilerplate and primarily repeats information that the reader can easily determine from the financial statements, being the 9% increase in sales. It states that the increase is mainly due to sales of product X, but it doesn't explain why the sales of product X increased or any changes in other product lines that may have offset the sale of product X. This disclosure doesn't provide useful information to enable the reader to understand the increase in revenues. Slide 12 has an example of improved entity-specific disclosure for the same company.
During fiscal 2016, the company's sales increased by 9%. The company undertook a new activity, namely the distribution of X product in the Canadian manufacturing sector. As at year-end, because of a delay in the manufacturing of X products, this activity had not yet reached the level that management had anticipated. The sales of X products increased sales by 7%. Since 30% of sales are made in US dollars, the depreciation of the Canadian dollar had a positive impact on sales. This impact was a 3% increase in sales. Despite the positive effect of the introduction of X product and of the exchange rate, the arrival of a new competitor forced the company to decrease its sale price on product Y. With this decrease, the company was able to maintain the sale volume of product Y. Due to the quality and reputation of product Y, management believes that no other decrease of the sale price will be necessary to maintain the sale volume of product Y in the future. The decrease in the sale price caused a 1% decrease in sales.
You'll note that this example provides a lot more detail beyond what the reader can find in the financial statements. For example, it explains that sales went up due to the introduction of product X and depreciation of the Canadian dollar, and the factors that offset this increase in sales being the decrease in sales of product Y. An important item to note is that the company has quantified the impact of each of these drivers. A key takeaway from example number 1 for issuers with revenue is to describe any changes caused by selling prices, quantities, or the introduction of new products and services. The next area I'd like to address is the discussion of operations for issuers with projects not yet generating revenue. I think some issuers struggle with this section of the MD&A when they don't have revenue. There's a misconception that discussion of operations only applies to items like revenues or cost of sales. However, security laws prescribe disclosure of some specific items to help investors further understand a company's operations in situations when discussion of revenues are not significant, such as a company that is still in the development stage. Section 1.4 of the MD&A form prescribes disclosure for issuers that have significant projects that have not yet generated revenue. The form requires a description of the project, a discussion of a company's plan for a project, and status against originally projected plans. We often find the initial discussion is not updated to show the company's progress against their initial plan. To be meaningful to investors, project updates should discuss the status of the plan, expenditures made in the current period, and expenditures to date, and anticipated time and cost to reach the next phase or milestone. This information is helpful to investors to understand the progress that an issuer has made on a project during the current period and to understand where the company is headed. Slide 14 is an example of disclosure that we often see in the MD&A for issuers that have significant projects that have not yet generated revenue.
In 2016, the company continued its exploration efforts on the XYZ Lake property, including additional drilling on the fire zone, which continued to intersect significant zone of mineralization. In addition, geophysical surveys identified several targets for testing, which may represent zones of mineralization similar to the fire zone. In 2017, the company expects to continue its drilling efforts to outline the fire zone mineralization and also drill test the geophysical targets. The company anticipates it will be in a position to disclose an initial mineral resource estimate on the XYZ Lake property in 2017.
This slide is an example of common disclosure by companies with projects that have not yet generated revenue that likely fails to comply with the securities law requirement. The disclosure is vague and lacks the detail and quantification that would make it meaningful. Although there is some discussion about next steps, there's no context about the project in terms of the specific progress and about the cost to take the project to the next stage. This slide illustrates improved disclosure on how an issuer could discuss its plans and expected expenditures for its projects. The example illustrated improved disclosure of how this relates to the timing and cost to take the project to the next stage. Entity-specific disclosure will vary based on the status of the project, which may include factors such as drilling, construction and development, engagement with authorities for approvals and permits, or engagement with locals for social licenses. The important takeaway from this slide is that significant projects that have not yet generated revenue should be considered as part of your discussion of results of operations, and the disclosure accompanying it should provide investors with a plan for the project, the status of the project relative to that plan, and expenditures made and how these relate to an anticipated timing and cost to take the project to the next stage of the plan. This slide, slide 16, has some reminders for you to consider when you're preparing your next MD&A. If you have revenue, don't forget to consider the price and volume analysis. If you have significant projects that have not yet generated revenue, don't forget to describe the project and the timing and cost to take the project to the next stage. In the bottom right bubble, something that I'll touch on later today, there are additional disclosure requirements for venture issuers without significant revenue. Another area we would like to see improved disclosure is the discussion of liquidity and capital resources in the MD&A. The form requirements are set out in items 1.6 and 1.7 of the MD&A form. We often find generic discussion of current cash balances and current working capital balances. A good analysis of liquidity involves a meaningful discussion of cash flows from operations, investing, and financing beyond stating balances from the financial statements. The disclosure should explain why management believes it has sufficient resources. Issuers can improve their discussion of working capital requirements by better explaining and quantifying their working capital needs and how their working capital needs relate to their plan for the next fiscal year or up to the next business milestone. Merely noting working capital in excess of last year's expenditures is not typically sufficient for investors to understand why the issuer has sufficient financial resources if the plan or outlook isn't also disclosed. Rather than repeating items that are reported in the statement of cash flows, a company should concentrate on disclosing the primary drivers of cash flows and the reasons for material changes in major sub-items underlying the line items reported in the financial statements. Companies should also consider whether they need to provide enhanced disclosures about significant debt instruments, guarantees, and covenants. This disclosure is important so that investors can anticipate any funding shortfalls and financing resources available to meet spending commitments and continue key projects. It's important to focus on realistic solutions and to provide an analysis that will let investors know how you'll carry on in your business. In addition, companies should disclose significant developments in liquidity or capital resources that occur after the balance sheet date. The next two slides summarize the requirements in the MD&A for liquidity and capital resources. They're included here for your reference, and we'll move along to the example. Slide 20 is an example of boilerplate disclosure of liquidity and capital resources.
At year-end, the company had cash of $10,000, total current assets of $500,000, and total current liabilities of $700,000. This resulted in a working capital deficiency of $200,000. Nonetheless, management is confident that the company has adequate financial resources to address its requirements and can arrange alternative sources of financing if necessary.
In this example, the company repeats the balances for cash, current assets, and current liabilities, which are readily available from the financial statements, but does not provide any analysis of what these balances mean in relation to the liquidity and capital resources of the company. The company also states that it has a working capital deficiency of $200,000, but does not explain how it plans to address this deficiency. The next two slides describe entity-specific disclosure.
The company had $500,000 of working capital at year-end. Fixed costs to maintain operations, pay taxes and royalties, and upkeep are about $60,000 per annum. Corporate and general costs to maintain the requirements of a listed company were $95,000 in both 2016 and 2015. Therefore, minimum working capital requirements are estimated at $155,000 per year. Estimated working capital requirements for 2017, $300,000 to complete a preliminary economic assessment, $155,000 for corporate and general, $1.2 million for convertible note repayment, for a total of $1.655 million.
The disclosure on this slide provides a more thorough analysis of the company's liquidity and capital resources by discussing the amounts needed to maintain operations, meet debt obligations, and fund development. Clear entity-specific disclosure is important so that investors can understand any anticipated funding shortfalls and financing resources available to meet spending commitments and continue key projects. It is important to focus on realistic solutions and to provide an analysis that will let investors know how the issuer will carry on its business. The entity-specific disclosure continues on the next slide.
As at December 31st, 2016, the company's cash and cash equivalents were $684,000. The company has access to sufficient funds to meet its current overhead requirements. The company also has sufficient cash to fund the PEA. The resulting PEA report will provide the basis of a decision to advance development, finance further exploration, or consider other options. The company does not currently have sufficient resources to repay the convertible notes in December 2017. The company plans to complete an offering of new debt securities in the fall to fund the repayment.
The company here also provides an analysis of potential sources of funding for each of its major cash uses in 2017. Overall, this disclosure provided a more meaningful and useful analysis of the company's liquidity and capital resources. Slide 23 has some reminders for you to consider when you're preparing your next MD&A. Don't forget to disclose your working capital requirements as well as an analysis of expenditures required to maintain capacity, meet planned growth, or fund development. In addition to the disclosure required in the discussion of operations for projects not yet generating revenues that I discussed earlier, there are additional disclosure requirements for venture issuers that have not had significant revenue in the last 2 years. This disclosure is also relevant and meaningful for smaller, non-revenue generating, non-venture issuers. This slide lists some of the specific costs that venture issuers without significant revenue must break down. The specific list of items can be found in Section 5.3 of National Instrument 51-102. A component of cost is generally considered to be a material component if it exceeds the greater of 20% of the total amount of the class and $25,000. Another takeaway from this slide is that if venture issuer's business is primarily involved in mining, exploration, and development, this analysis must be presented on a property-by-property basis. As far as presentation goes, this information may be disclosed in the financial statements or the MD&A.
So the next topic we're going to cover is forward-looking information. So what is forward-looking information? It is disclosure about possible events, conditions, or financial performance that is based on assumptions about future economic conditions and courses of action. It is relatively broad. As you can see on the chart, FLI includes 2 subcategories dealing with financial information: forward-looking financial information, or FOFI, and financial outlook. Both FOFI and financial outlooks are a subset of FLI that are about prospective financial performance, financial position, or cash flows, which are based on assumptions about future economic conditions and courses of action. The difference between FOFI and financial outlook is the format in which the financial information is presented. In the case of FOFI, the information is presented in the format of a historical financial statement, while it is not for a financial outlook. Examples of a financial outlook would include projected EBITDA, expected revenue, profit or loss, EPS, or R&D spending. We don't see FOFI very often. When we do, the disclosure is generally found in prospectuses or rights offerings. An example of FLI that is not FOFI or financial outlook would be an estimate of future store openings by an issuer in the retail industry. We will now review key considerations and expectations when disclosing FLI. Is FLI identified? For example, has the issuer noted that projected revenue is forward-looking information? Is there a reasonable basis for the disclosed FLI? In determining what constitutes a reasonable basis for FLI, a reporting issuer should consider the reasonableness of the assumptions underlying the FLI and the process followed in preparing and reviewing the FLI, as this could be misleading if not disclosed and not very useful. Are assumptions supporting financial outlook and FOFI reasonable, entity-specific, and disclosed? For example, does the issuer disclose what the assumptions are that support the projected revenue figure? Is the FLI presented for a reasonable period? For example, has the issuer presented revenue for multiple years? Have issuers been cautioned that actual results may vary from FLI? Have the risk factors that could cause actual results to vary been identified? And this is a key point. Updating previously disclosed FLI helps investors understand how actual results will differ materially from FLI and how the reporting issuer is progressing in relation to its plan. If events or circumstances occur which make it unlikely that material FLI will be achieved in the future, then there is a responsibility to provide an update. And finally, have material differences between actual results and previously disclosed financial outlook and FOFI been disclosed? So I also wanted to highlight some findings from our recently published Corporate Finance Branch report. We have seen that many issuers disclose FLI in news releases, MD&A, prospectus filings, marketing materials, investor presentations, or even on their website. Some of our recent observations include the following. There are generic factors and assumptions continue to be disclosed, and FLI assumptions are not being quantified. As I've previously discussed, disclosure of specific and relevant material factors or assumptions, including material risk factors underlying FLI, is needed for investors to understand how actual results may vary from the FLI. In addition, we wanted to highlight some findings related to issuers that disclose FLI in their prospectus or CD documents for a period beyond the issuer's next fiscal year end. For example, multiple year targets for projected EBITDA for fiscal 2018 and beyond. So we continue to observe that issuers are not providing reasonable and sufficient assumptions to support the FLI beyond the fiscal year end. Part 4B of National Instrument 51102 states that an issuer must not disclose a financial outlook unless the financial outlook is based on assumptions that are reasonable in the circumstances. It further states that the financial outlook that is based on assumptions that are reasonable in the circumstances must be limited to a period for which the information in the financial outlook can be reasonably estimated. In many cases, that time period will not go beyond the end of the reporting issuer's next fiscal year. As a result, in our reviews, we may raise comments in respect of the reasonableness of the time period of FLI presented. Where FLI is presented for multiple years and is not sufficiently supported by reasonable qualitative and quantitative assumptions, we may ask issuers to limit that disclosure of FLI to a shorter period, for example, to 1 year, for which reasonable support exists. For investors to assess whether the assumptions underlying the issuer's FLI are reasonable, the issuer should disclose those assumptions in the prospectus and CD documents as applicable, both quantitatively and qualitatively. So for example, an issuer projecting aggressive growth targets without the benefit of historical experience should be able to show, firstly, a reasonable basis for those targets, including the key drivers behind the projected growth with reference to specific plans and objectives that support the projected growth, and secondly, why management believes that each of the targets or FLI are reasonable. In these cases, due to the long-term nature of FLI, it becomes even more important that issuers update previously disclosed FLI on a regular basis in their continuous disclosure by including a comparison of actual results to previously disclosed FLI. We will now highlight an example that illustrates this point. So just to touch on some of the observations I have just discussed, we wanted to highlight a disclosure example related to comparison of actual results to previously disclosed FLI. In this example, the company simply discloses ABC Company achieved sales growth of 10.5% in 2016 and maintained capital expenditures at $50 million. As you can see, this disclosure does not provide a comparison of actual results to previously disclosed FLI. So this is a good example of entity-specific disclosure. The issuer provides a table that lists its 2016 objectives and then provides a comparison to the actual results. For example, the 2016 objective is that the issuer will achieve sales growth of 3 to 4%. On the right-hand side, the issuer describes its accomplishments towards achieving this objective and states that the issuer had sales growth of 10.5% and further explains that the increase in sales growth achieved during fiscal 2016 was due to the introduction of product XX in Q3, which resulted in sales growth of 6% and a 75% increase in the sales volume of product R, which explains the remaining increase in sales growth. Here, you can see that there is a quantitative and qualitative discussion of material differences, and investors can clearly see the difference in the amount achieved and understand the why. This disclosure is informative, clear, and useful. This disclosure is important for investors in their assessment of the effectiveness of management and of current and future business performance of the company. A comparison will allow investors the opportunity to assess the reasonableness of previously disclosed FLI and adjust expectations accordingly. So now we will turn to non-GAAP financial measures. So a non-GAAP financial measure is a numerical measure of an issuer's financial performance, financial position, or cash flow that doesn't meet the criteria of the issuer's GAAP for presentation in its financial statements, but is derived from a numerical measure in the financial statements. This definition, which is also found at the bottom of this slide, makes it clear that non-GAAP financial measures are outside the financial statements. So we often see these measures presented in press releases, MD&A, and prospectuses. And some common non-GAAP financial measures that we see are EBITDA, free cash flow, adjusted earnings per share, and cash cost per ounce, which would be applicable to mining issuers. So non-GAAP financial measures are alternative means for presenting financial performance, but they generally exclude various items from GAAP results. We understand that investors want tailored metrics to help make informed investment decisions. And this makes companies want to tell their stories in ways other than just the GAAP number. But we also want to ensure that they are presented in a way which is not potentially misleading. And I'll now go into more detail. So how do we regulate non-GAAP financial measures today? Staff Notice 52306 sets out our disclosure expectations for non-GAAP financial measures, which are intended to ensure investors understand each non-GAAP financial measure, know the limits of their use or relevance, and contextualize them compared to other required disclosures. If an issuer discloses a non-GAAP financial measure in its MD&A, press release, or in other continuous disclosure documents, staff expect that the disclosure includes the information outlined in detail in this staff notice. The disclosure should include identifying a measure as a non-GAAP financial measure, specifically identifying a non-GAAP financial measure by including a section in your disclosure document for this purpose. State explicitly that the measure has no standardized meaning under GAAP and therefore may not be comparable to similar measures presented by other companies. Include disclosure of the most directly comparable GAAP measure with a reconciliation between the two measures. This is a key disclosure requirement to ensure that investors understand how the measure is derived. Explain why the measure is useful to management and investors. How does the company use this measure, and why is this something that investors want? Explain any changes in the composition of the measure from year to year. For example, how adjusted EBITDA may have changed. The staff notice also includes our expectation that non-GAAP financial measures are not given greater prominence as compared to IFRS numbers. So in the past few years, we have done several reviews of non-GAAP financial measures. In the 2013 OSC review of 50 issuers, we had concerns in 86% of issuers and required a number of reporting issuers to refile their continuous disclosure documents to address the concerns noted. This slide shows some general observations on recent findings. In terms of identification, issuers often do not identify a measure as a non-GAAP financial measure. In terms of naming, names often do not accurately represent the composition of the measure. For instance, companies will label measures as operating earnings with operating items inappropriately excluded. In terms of usefulness, companies often do not explain why the measure provides useful information to investors. In terms of prominence, greater prominence is often given to the non-GAAP financial measure, and there is little discussion of the GAAP measure. Prominence has spill-on effects and could result in the press picking up the non-GAAP financial measure information rather than the GAAP info. In terms of breadth, we have seen a large number of non-GAAP financial measures being used, such as adjusted EBITDA, operating earnings, core earnings, and these sometimes can obscure material GAAP information. And finally, in terms of reconciliation, we have seen the reconciliations to help investors understand how the measure is derived are often not being provided in continuous disclosure documents. When considering a communication strategy related to non-GAAP financial measures in your continuous disclosure documents, issuers should think about: 1, are non-GAAP financial measures more prominent than GAAP measures? Companies should discuss the GAAP measure first and ensure that greater prominence is given to it. Number 2, how many non-GAAP financial measures does the company need to tell its story? In disclosing too many non-GAAP financial measures, companies run the risk of losing investor focus and obscuring material information. This could also result in disclosure overload. Are non-GAAP measures deliberately changing the company's story? For instance, has an issuer presented operating income that inappropriately excludes impairment? Impairment is an item of operations in the accounting world, and so it would appear misleading to present operating income and exclude impairment in this measure. Our recently published Corporate Finance Branch report also discusses our observations related to non-GAAP financial measures. In many cases, we are quite concerned about the prominence of disclosure given to non-GAAP financial measures, the visibility and clarity of adjustments made, and the appropriateness of the adjustments themselves. For example, defining an adjustment such as acquisition costs as one time when these are recurring every year. When providing non-GAAP financial information, issuers should ensure that they are not obscuring the GAAP results. In our branch report, we also discuss certain industry-specific observations. So in terms of the mining industry, non-GAAP financial measures are commonly used in describing production costs at producing mines and free cash flow at development projects. CSA Staff Notice 52306 applies to disclosure of the results of economic analysis and to disclosure of production results and production guidance. Specifically, we remind issuers disclosing non-GAAP financial measures on mineral projects that they should state clearly that the non-GAAP financial measure is a non-GAAP financial measure. They should apply that measure consistently from period to period across documents and provide a clear explanation of how the measure is calculated. We are also seeing non-GAAP financial measures presented in investor presentations. We remind companies that the measure should be consistent with the non-GAAP financial measures disclosed in CD filings and be clearly identified and explained. In terms of the real estate industry, recent reviews of real estate investment trusts, or REITs, in Ontario have resulted in important disclosure improvements in this area, although inconsistencies remain in how these non-GAAP financial measures are being presented. As distribution sustainability is of key importance to a REIT, issuers should adequately disclose the sources of cash flow for distributions in a particular period, the impact to the REIT, and its ability to sustain distributions over the long term. One of a REIT's key ratios disclosed is the payout ratio, analyzed in terms of the REIT's distribution as a percentage of funds from operations and adjusted funds from operations, two of a REIT's main non-GAAP financial measures. We have noted concerns regarding the prominence of funds from operations and adjusted funds from operations, as well as unclear adjustments being made in deriving these measures. improvements can still be made to enhance the transparency of REIT distribution disclosures when payout ratios are used. And finally, in the tech and biotech industries, we commonly see disclosures of EBITDA, and adjusted earnings per share. Our concerns in these cases are prominence of these measures and the appropriateness of the adjustments being made. We are seeing that adjustments are inappropriately being described as non-recurring, infrequent, or unusual. The description of adjustments in this manner is not appropriate when a similar loss or gain is reasonably likely to occur within the next 2 years or occurred during the prior 2 years. Also, we remind issuers that in presenting EBITDA as a non-GAAP financial measure, it may be considered misleading to exclude amounts for items other than interest, taxes, depreciation, and amortization. I will now highlight an example that illustrates this point. So as an example on the slide, based on our reviews, we noted that the composition of EBITDA is often inconsistent with its commonly understood meaning. In this slide, we noted that additional adjustments are made to EBITDA to make the metric look more positive. When additional adjustments are included in the standard EBITDA calculation, the measure could be seen as potentially misleading or confusing to investors. In this example, adjustments for impairment, restructuring, and foreign exchange charges have been made to EBITDA, which makes the non-GAAP measure potentially misleading because it excludes more than just interest, taxes, depreciation, and amortization. So this example illustrates better and more transparent disclosure where the impairment, restructuring, and foreign exchange charges are not included as part of the EBITDA calculation, but rather they are applied to EBITDA to arrive at adjusted EBITDA. In addition to the table above, in order to ensure that the disclosure is not misleading, the issuer should also include all material disclosures set out in Staff Notice 52-306. So in this slide, we just wanted to highlight the oversight role of audit committees as it relates to non-GAAP financial measures. Audit committee members should seek to understand management's judgments in the design, preparation, and presentation of non-GAAP financial measures, and how those measures might differ from approaches followed by other companies. These discussions will require an understanding of the company's business model and how it is managed. So finally, the Canadian Securities Administrators are currently working on a rule to change the current staff guidance on non-GAAP financial measures in Staff Notice 52-306 into law. The goal is to enhance our compliance efforts and provide greater clarity to reporting issuers. We expect that the rule will be built upon the principles of Staff Notice 52-306. And subject to Commission approval, we are planning a publication for comment next year.
So now that we've talked about the MD&A, the next topic I want to talk to you today about is venture issuer regulation. One of the recent policy initiatives of the Corporate Finance Branch was in relation to venture issuer regulation. The initiative resulted in amendments to continuous disclosure, prospectus, and governance requirements, which became effective beginning in 2015. The substance and purpose of the amendments were to focus the disclosure of venture issuers on information that reflects the needs and expectations of venture issuer investors and to modify disclosure obligations that may be less valuable to those investors. The amendments were also intended to streamline the disclosure requirements for venture issuers to allow management of these issuers to focus on the growth of their business and to enhance the substantive governance requirements for venture issuers. This slide summarizes the changes made as a result of the Venture Issuer Regulation Project. I will discuss each of the changes in more depth in the following slides. In particular, the amendments allow all venture issuers to meet interim MD&A requirements by preparing a streamlined and focused report entitled Quarterly Highlights. It also allows issuers to reduce the instances in which a business acquisition report, also called a BAR, must be filed, to implement a new tailored form of executive compensation disclosure. It amends the prospectus disclosure requirements to reduce the number of years of audited financial statements required for venture issuers becoming reporting issuers, and to harmonize the disclosure requirements related to similar requirements under continuous disclosure. and creates a new requirement for audit committees to have a majority of independent members. The tables on the next two slides summarize the new rules for venture issuers that became effective in June 2015. The top row on slide 45 describes an alternative to allow all venture issuers to meet interim MD&A requirements by preparing a streamlined and highly focused report entitled Quarterly Highlights. As I previously mentioned, the MD&A is a narrative explanation through the eyes of management about the issuer's performance during the financial period and is intended to supplement and complement the financial statements. The MD&A disclosure must be useful and understandable. Regardless of whether an issuer is preparing a full interim MD&A or a venture issuer is preparing a quarterly highlights, the issuer should avoid boilerplate disclosure that merely repeats information from the financial statements. Tell the story, don't just repeat the numbers. As opposed to the current interim MD&A, which requires updating of each item discussed in the annual MD&A, issuers preparing a quarterly highlights should provide a short, focused discussion that gives a balanced and accurate picture of the company's business activities during that interim period. The purpose of the quarterly highlight reportings is to provide a brief narrative update about the business activities, financial condition, financial performance, and cash flow of the company. While summaries are to be clear and concise, they are subject to the normal prohibitions against false and misleading statements. As I mentioned earlier, the form Quarterly Highlights is optional, and as such, venture issuers should take the needs of their investors into consideration when determining whether to provide quarterly highlights or full interim MD&A. For smaller venture issuers, quarterly highlights may well provide sufficient information to satisfy the needs of their investors. However, for larger venture issuers, or venture issuers with revenue from operations, it is probably more difficult to describe what happened in the quarter without discussing in details variances in revenues or variances in expenses, for example. It may, in other words, be difficult to tell the story, so to speak, if using the quarterly highlights form instead of the full interim MD&A. Also, investors in larger venture issuers, including those with significant revenue, may want full interim MD&A to assist them in making informed investment decisions. Venture issuers should take the opportunity to revisit their MD&A or quarterly highlights disclosure. If your company is a venture issuer without significant revenue from operations, consider focusing your discussion and analysis of financial performance on expenditures and progress towards achieving your business objectives and milestones. As I mentioned, a venture issuer that provides quarterly highlights is not required to update its annual MD&A in the quarterly highlights. However, to meet the requirements of Section 2.2.1 of Form 51102F1, which is the MD&A form, the venture issuer should disclose in its quarterly highlights any change, if material, from plans disclosed in the annual MD&A. For example, if a mining issuer discloses a drill program in its annual MD&A and decides to make a change to that drill program in a subsequent interim period, that change, if material, should be disclosed in the quarterly highlights for that period. The second change affecting venture issuers is with respect to the requirements for a business acquisition report. All venture issuers and non-venture issuers must file a BAR using Form 51102F4 within 75 days of a significant acquisition. The BAR must include audited financial statements for the most recent financial year and pro forma financial statements. Prior to the amendments for venture issuers, an acquisition was significant if the asset and investment test specified in Part 8 of National Instrument 51102 is satisfied at the 40% level. Under the amendments, the threshold for venture issuers has increased from 40% to 100%, therefore reducing the instances where BARs are required and eliminating the requirements that BARs filed by venture issuers must include pro forma financial statements. This change also applies where BAR level disclosure is required, so in information circulars and short form prospectuses, for example. The third change on this slide relates to executive compensation. Prior to the amendments, all issuers, whether they are venture or non-venture, were required to file executive compensation disclosure using Form 51102F6. The disclosure requirements that apply to venture and non-venture issuers are nearly identical in the F6 form. we introduced changes that allow venture issuers to use a new optional venture issuer form, Form 51-102 F6V. The new form requires the disclosure of only 3 named executive officers instead of 5. It requires the disclosure for only the 2 previous financial years instead of 3. And it eliminates the requirement for venture issuers to calculate and disclose the grant date fair value of stock options and other share-based awards in the summary compensation table. Instead, venture issuers should disclose detailed information about stock options and other equity-based awards issued, held, and exercised. This is consistent with the approach to disclosure taken in the US for smaller reporting companies. Venture issuers may choose whether to comply with Form 51-102 F6 or the new Form 51-102 F6V. The top row on slide 46 summarizes changes to prospectus disclosure requirements to reduce the number of years of audited financial statements required for venture issuers becoming reporting issuers from 3 to 2. Changes were also made to the prospectus rule to harmonize the disclosure requirements related to similar requirements under continuous disclosure to permit venture issuers to use quarterly highlights instead of existing interim MD&A in the prospectus, to comply with the amended executive compensation disclosure requirements, and requiring the inclusion of bar-level disclosure in a prospectus of a venture issuer only where the acquisition is significant at the 100% level. The last item I want to note is that there's a new requirement for audit committees to have a majority of independent members that came into effect in June 2015. Under the previous rules, venture issuers were not subject to any requirements with respect to the composition of the audit committee. Now, venture issuers are required to have an audit committee consisting of at least 3 members, the majority of whom should not be executive officers, employees, or control persons of the issuer. This requirement is equivalent to a TSX venture exchange requirement under exchange policies.
Our next topic is on issuers' use of social media. CSA staff recently conducted a review of reporting issuers' use of social media. In March of this year, Staff Notice 51-348 on this topic was published. When we initiated the review, there was a strong level of interest, mainly because of the widespread issuer use of social media in recent years. As a new and growing platform, social media is a simple, low-cost communication tool which is readily available to issuers and accessible to most investors and the public in general. However, there are a number of security law obligations that are important to keep in mind when using social media. The review began with the participating jurisdictions selecting 111 issuers for review across a broad range of industries. Of the issuers that we reviewed, we noted that a significant portion, 72%, were actively using social media. For these issuers, we looked at the information they had provided on various websites such as Facebook, Twitter, and YouTube. In raising comments, we generally benchmarked any issues we saw against our disclosure standards, which are outlined in National Policy 51-201. While the social media venue was unique to this review, the types of issues that we found on social media were similar to those we often observe in traditional disclosure formats. There are 2 main areas where we identified issues in our review. The first is selective disclosure. In some cases, we noted instances where issuers had provided forward-looking information on social media without ensuring that this information was generally disclosed, for instance, through a press release filed on SEDAR. The forward-looking information tended to include revenue and cash flow targets, as well as expected timing for future milestones. We also noted that issuers that were selectively disclosing forward-looking information on social media tended to not be compliant with other related forward-looking disclosure obligations. Another example of selective disclosure involved a lack of coordination as to the timing of social media announcements. Here, it was not that issuers were disclosing information about events that had recently occurred solely through social media. Rather, the social media disclosure was provided prior to the information being generally disclosed. While those first 2 examples generally involve positive information being disclosed by an issuer, a third area of selective disclosure concerns involve third parties posting potentially material information on social media about an issuer, generally more negative information in nature, which the issuer itself had not disclosed. This highlights the breadth of the information stakeholders can access on social media and the significance of social media as a means for investors to receive information about issuers. Other key areas of unbalanced or misleading disclosure on social media included instances where social media postings were untrue or were promotional to an extent that they could have misled investors. For example, some issuers posted financial information on social media that was not consistent with their financial information in their continuous disclosure record on SEDAR. Concerns about misleading or untrue statements provided through links on the issuer's social media site to other documents, such as analyst reports and other articles prepared by third parties, was also an issue. Some of these documents contained aggressive price targets for the issuer or forward-looking information about the issuer that did not appear to have been otherwise disclosed. In several instances, the issuers had provided compensation in connection with the third-party document, but did not prominently disclose this fact in the document. In terms of outcomes, after receiving our comment letters, 30% of the issuers in our sample that were using social media took action to improve their disclosure, including filing clarifying disclosure on SEDAR and/or editing or removing disclosure on social media, making prospective commitments to improve social media disclosure, or making improvements to internal disclosure controls or governance policies. For instance, adopting a social media governance policy or restricting access to posting on social media to certain insiders. We found that most issuers in our sample, 77%, did not have a specific social media policy in place. Given this finding, and in light of the prevalent use of social media, as well as the relative ease for issuers and their insiders to access it, we noted the importance of having a strong social media governance framework in place. We also provided a non-exhaustive list of items that we think a social media policy should address. Also of note is that several of the issuers in our sample posted selective, misleading, or unbalanced disclosure on social media that appeared to result in material stock price movements. None of these issuers had a social media governance policy in place. When providing information on social media, consider the following to prevent unbalanced and misleading disclosure. Do not make a statement that is misleading or untrue, or which omits a relevant fact that is necessary to make that statement not misleading. When announcing a material change, consider whether the announcement is factual and balanced. Disclose unfavorable news as promptly and as completely as favorable news, and ensure press releases or other documents provide sufficient detail, while at the same time avoiding unnecessary details, exaggerated reports, and promotional commentary. Also keep in mind the following regarding selective disclosure. Informing anyone of material non-public information before that information has been generally disclosed is generally prohibited, and posting material information on a social media website is not acceptable as the sole means of satisfying the requirement to generally disclose. I'll now pass it over to Yan to discuss our next topic.
Our next topic is on assessing material information and providing balanced disclosure. It is fundamental that everyone investing in securities have equal access to information that may affect their investment decisions. We will first discuss how to assess material information, including the materiality standard and how that affects disclosure obligations, materiality determinations, and go over some examples of potentially material information. Once an issuer has identified material information that ought to be disclosed, the disclosure ought to be balanced. This will be the second topic discussed in this section. In considering whether information is required to be disclosed, the determining factor is materiality. There are two materiality standards that are defined: material change and material fact. The definitions of material change and material fact are found under subsection 1(1) of the Securities Act and are based on a market impact test. Material change, when used in relation to an issuer other than an investment fund, means a change in the business, operations, or capital of the issuer that would reasonably be expected to have a significant effect on the market price or value of any of the securities of the issuer, or a decision to implement such a change. Material fact, when used in relation to securities issued or proposed to be issued, means a fact that would reasonably be expected to have a significant effect on the market price or value of the securities. The concept of material change should be distinguished from that of material fact. As you can see, the term material change refers explicitly to a change in the business, operations, or capital of the issuer. Events, occurrences, or developments that are external to the issuer, if they do not involve changes to the issuer's business, operations, or capital, may not be a material change, although they may be a material fact. For the purposes of continuous disclosure, the distinction affects the timing of the required disclosure under securities law. If it is a material change, the issuer has an immediate disclosure obligation. Under securities legislation, material facts are not generally required to be publicly disclosed as they occur. It is worth pointing out that exchange policies differ. The TSX and TSX Venture policies require the timely disclosure of material information. Material information includes both material facts and material changes relating to the business and affairs of a company. Therefore, the timely disclosure obligations in the exchange's policies exceed those found in securities legislation. Listed companies are required to comply with the requirements of the exchange they are listed on. The securities law obligation to disclose a material change is set out at Section 75 of the Securities Act. Where a material change occurs in the affairs of a reporting issuer, it shall forthwith issue and file a news release authorized by a senior officer disclosing the nature and substance of the change. The reporting issuer shall also file the report of such material change as soon as practicable and in any event within 10 days of the date on which the change occurs. These disclosure requirements are set out at Part 7 of National Instrument 51102, which also contains the specified form for a material change report at Form 51102F3. Here, issuers are required to include a full description of the material change with sufficient disclosure to enable a reader to appreciate the significance and impact of the material change without having to refer to other material. Note, however, that if in the opinion of the company, the disclosure would be unduly detrimental to the interests of the company, then the company can make a confidential filing with the Securities Commission if it meets the requirement under the rule. With respect to an issuer's other continuous disclosure obligations, the disclosure standard is material information, which would encompass both material changes and material facts. For example, Form 51102F1, which is the MD&A, requires, amongst other things, a discussion of material information that may not be fully reflected in the financial statements, such as contingent liabilities, defaults under debt, off-balance sheet financing arrangements, or other contractual obligations. As set out at Part 1E of the MD&A should focus on material information, and there is no requirement to disclose information that is not material. You will need to exercise your judgment when determining whether information is material, and we provide some guidance in the next slide regarding what to consider in making your materiality determinations. The test for materiality is set out at Part 1F of the MD&A form, which is, would a reasonable investor's decision whether or not to buy, sell, or hold securities in your company likely be influenced or changed if the information in question was omitted or misstated? If the answer to this question is yes, the information is likely material. This test for materiality is objective and is based on a reasonable person's test. This concept of materiality is also consistent with the financial reporting notion of materiality contained in the Canadian Institute of Chartered Accountants Handbook. The same focus on material information and test for materiality is reiterated in Parts 1D and 1E of the AIF form, which is Form 51102F2. However, we note that AIF is not required for venture issuers. So the key question for an issuer is whether the information under consideration is material and requires disclosure. We will discuss some factors to consider when making materiality determinations. Some guidance may be found at Section 4.2 of National Policy 51-201, Disclosure Standards. We know that there's no simple bright line standard or test. It's necessary to take into account a number of factors, including the nature of the information itself, the volatility of the company's securities and prevailing market conditions. The materiality of a particular event or piece of information may vary between companies according to their size, the nature of the operations, and many other factors. Therefore, an event that may be significant or major for a smaller company may not be material for a larger company. Companies should avoid taking an overly technical approach to determining materiality. Second, we encourage companies to monitor the market's reaction to information that is publicly disclosed. Ongoing monitoring and assessment of market reaction to different disclosure will be helpful when making materiality judgments in the future. As a guiding principle, if there is any doubt whether particular information is material, we encourage companies to err on the side of materiality and release the information publicly. So Section 4.3 of National Policy 51-201 provides a list of examples of the types of events or information which may be material. This list includes the following: changes in corporate structure, changes in capital structure, changes in financial results, changes in business and operations, acquisitions and dispositions, and changes in credit arrangements. We encourage issuers to review this list. This list is not exhaustive and is not a substitute for companies exercising their own judgment in making materiality determinations. For example, the context and timing of events or information are relevant to the materiality determination. Another example may be found in CSA Multilateral Staff Notice 51-347 regarding the disclosure of cybersecurity risks and incidents, published in January of this year, where we noted that materiality in cases of cybersecurity risks turns on an analysis of the probability that a breach will occur and the anticipated magnitude of its effects. As noted in the MD&A and the AIF forms, issuers should exercise their judgment when determining whether information is material. To this extent, we recommend that the topic of how to decide what information is material be part of an issuer's written corporate disclosure policy. So once an issuer has identified material information that ought to be disclosed, the disclosure ought to be balanced. I will first walk through the provisions from Ontario securities legislation, instruments, and rules that are relevant to the requirement to provide balanced disclosure. Then I will review some recent staff guidance in this area. Finally, I will finish off with some tips on how you can better provide balanced disclosure. Subsection 126.2, subsection 1 of the Securities Act speaks to misleading or untrue statements. It provides that a person or company shall not make a statement that the person or company knows or reasonably ought to know in a material respect and at the time and in the light of the circumstances under which it was made is misleading or untrue or does not state a fact that is required to be stated or that is necessary to make the statement not misleading and would reasonably be expected to have a significant effect on the market price or value of a security, derivative, or underlying interest of a derivative. Unbalanced disclosure is potentially misleading. Therefore, issuers should strive to provide balanced disclosure. This subsection of the Securities Act applies broadly to all statements made by an issuer, including press releases, website disclosure, as well as social media disclosure, which we will discuss specifically. National Instrument 51-102 governs requirements on the timing and content of a reporting issuer's continuous disclosure record. With respect to the MD&A specifically, Part 1A of the Form 51-102F1 sets out the requirement to provide balanced disclosure in the MD&A, stating, your objective when preparing the MD&A should be to improve your company's overall financial disclosure by giving a balanced discussion of your company's financial performance and financial condition, including without limitations such considerations as liquidity and capital resources, openly reporting bad news as well as good news. National Policy 51-201 contains further guidance on the importance of providing balanced disclosure to investors in other disclosure documents, such as press releases. Subsection 2.1, subsection 2 of NP 51-201 states that announcements of material changes should be factual and balanced. Unfavorable news must be disclosed just as promptly and completely as favorable news. This subsection also states that a company's press release should contain enough detail to enable the media and investors to understand the substance and importance of the change it is disclosing. Avoid including unnecessary details, exaggerated reports, or promotional commentary. Next, I will review some recent staff guidance that touch on the requirement to provide balanced disclosure. CSA Staff Notice 51-342 regarding staff's review of issuers entering into medical marijuana business opportunities summarizes our review of disclosure provided by certain reporting issuers that announce publicly their intention to enter into Canada's medical marijuana industry. We found that issuers' disclosure was often unbalanced and promotional in nature. While the benefits associated with involvement in the medical marijuana industry were often discussed, these discussions were not consistently accompanied by disclosure about the risks, uncertainties, cost implications, and time required before the issuer would be able to begin licensed operations. The guidance in this notice is equally applicable to all industries, particularly companies thinking about material changes to their primary business or where an event has or will have an impact on future prospects. As we discussed earlier, there are other requirements associated with a material change, including the requirement that companies file a material change report, as well as issue and file a news release. The takeaways from the notice include the following. Announcements about significant events and business developments should contain balanced disclosure about any associated risks, uncertainties, or barriers to achieving the events being announced rather than promotional commentary. And as my colleague already discussed in the prior section, in CSA Staff Notice 51-348 regarding social media, our review of the disclosure provided on social media by a number of reporting issuers found misleading and unbalanced social media disclosure where information was not sufficient to provide a complete picture or was inconsistent with information disclosed by issuers on SEDAR. We remind issuers that when we identify material disclosure deficiencies, we will request that the issuer correct the deficiency by clarifying the disclosure. We may also consider further action, including enforcement action, depending on the circumstances. I'll now go over some things to consider on how an issuer can provide better balanced disclosure. First, we encourage issuers to establish a written corporate disclosure policy. Additional guidance can be found at Section 6.2 of National Policy 51-201. Second, once a decision to issue a press release or material change report has been made, the issuer needs to consider the level of disclosure to be provided, and at a minimum, consider including information regarding the time and resources required to complete the change in business and barriers and obligations involved in realizing the change, that is, any risks and uncertainties as applicable. And include sufficient detail in order for investors to be able to understand the nature of the opportunity and therefore the probability of realization. Third, it is important to provide subsequent updates about previously announced business opportunities in a timely manner, including when such updates may be considered negative news. If events occur which make it likely that the contracts and revenue opportunities originally announced would not transpire, provide a timely update.
Another example of a policy initiative, this time applying to non-venture issuers, is our review of women on boards and in executive officer positions. So by way of background, our corporate governance disclosure rule National Instrument 58101, requires TSX listed and other non-venture reporting issuers to provide corporate governance disclosure relating to the representation of women on boards and in executive officer positions, among other things. These disclosure requirements came into force on December 31st, 2014, and rely on a comply or exchange model. The 5 key areas of disclosure required by the rule are: 1, the number of women on boards and in executive officer positions; 2, policies regarding the representation of women on boards; 3, targets regarding the representation of both women on boards and in executive officer positions; 4, director term limits and other mechanisms of board renewal; and 5, consideration of the representation of women in the director identification and selection process and when making executive officer appointments. The objectives of the requirements are to increase the transparency for investors and other stakeholders, to assist in voting and investment decisions, and to encourage more effective boards and better corporate governance and decision-making. So recently on October 2017, October 5th, we published CSA Staff Notice 58309, which reports the findings from our 3rd review of these disclosures required by National Instrument 58101. The staff notice highlights the trends that we have observed in the last 3 reviews, as well as certain compliance findings. Specifically, we reviewed 660 issuers with year ends between December 31st, 2016 and March 31st, 2017, which filed information circulars or annual information forms by July 31st of this year. The prior review samples were 677 issuers last year and 722 issuers in 2015. So overall, 61% of issuers have at least one woman on their board, compared to 55% last year and 49% in the first year. This improvement was reflected not just in the number of issuers with a woman on their board, but also in the overall number of women holding board seats. 15% of issuers added one or more women to their board in the past year, which contributes to the overall percentage of board seats occupied by women, which has increased to 14% this year, from 12% last year and 11% in the first year. This increase was seen for all sizes of issuers, with the biggest improvement seen for issuers that have a market capitalization of $1 to $2 billion. For our largest issuers, those with over $10 billion in market cap, women hold 24% of the board seats, which is up from 21% in the first year. We've also seen a slight increase in the number of issuers with at least one woman in an executive officer position, from 60% in the first year to 62% in the current year, but not nearly the movement that we've seen with women on boards. In our sample, 35% of issuers disclosed that they had adopted a policy relating to the identification and nomination of women directors, which is up from 21% in year 2 and 15% in the first year. Although a greater percentage of issuers are adopting policies, over half of issuers elected to not adopt a policy. Other issuers had broader diversity policies that did not have specific provisions relating to the identification and nomination of women directors. For issuers of all sizes, those that had a policy relating to the representation of women on their board had a higher percentage of women on their board than issuers without a policy, and this has been consistent over the past 3 years. Again, this year, we saw a very low percentage of issuers that adopted targets for both board and executive officer positions. Only 11% of issuers set a board target, compared to 9% last year and 7% in the first year. Only 3% of issuers set an executive officer target, which is fairly consistent with prior years. The most common reason cited for not adopting targets was that candidates are selected based on merit. Regardless of the size of the issuer, for issuers that have board targets, we saw a greater percentage of women on their board when compared to issuers without targets. We found that 21% of issuers adopted director term limits, which is not a significant change from the 20% in year 2 and the 19% in year 1. Issuers adopted different forms of director term limits, including age limits, tenure limits, or both age and tenure limits. And these have remained fairly consistent over the past 3 reviews.
Since it is near fiscal year end for many issuers, it is worth reviewing the topic of annual filings. We will go through the key filings and general requirements. Annual financial statements must be filed, in the case of venture issuers, on or before the 120th day after the end of the issuer's financial year. In the case of non-venture issuers, on or before the 90th day after the end of the issuer's financial year. The disclosure requirement can be found at Part 4 of National Instrument 51102. The financial statements must provide comparative financial information and must be audited. The financial statements must also comply with National Instrument 52107. The financial statements must be approved by the company's board of directors before filing. The Management's Discussion and Analysis, or MD&A, was discussed earlier in this presentation by my colleague. The MD&A is required to be filed at the same time as the financial statements. The MD&A must be approved by the company's board of directors before filing. The disclosure requirement can be found at Part 5 of National Instrument 51102, and the MD&A must be prepared in accordance with Form 51102F1. Annual certificates are required to be filed with an issuer's financial statements and MD&A. The certificate must be certified by a certifying officer, which is usually the CEO and CFO. The certificate must be dated on the same date as when they are filed. The disclosure requirement can be found at National Instrument 52109. Non-venture issuers are required to sign a full certificate in the form of Form 52109F1, which includes representations relating to the establishment and maintenance of disclosure controls and procedures and internal control over financial reporting. For venture issuers, there is a Venture Issuer Basic Certificate in Form 52109FV1. In contrast to non-venture companies, certificates of venture companies do not provide representations relating to the establishment and maintenance of disclosure controls and procedures and internal control over financial reporting. Each certifying officer certifies that they reviewed the applicable filings. Applicable filings do not contain misrepresentations, and applicable filings are fairly presented. The Annual Information Form, or AIF, is required for any issuer who does not meet the definition of a venture issuer. The AIF is intended to provide material information about your company and its business at a point in time, which is generally as at the last day of your most recently completed financial year. This should be in the context of historical and possible development. The AIF should describe your company, its operations and prospects, risks, and other external factors that impact your company specifically. This disclosure is supplemented throughout the year by subsequent continuous disclosure filings. Although not required, we know that some venture issuers do elect to prepare an AIF. One of the reasons a venture issuer may elect to prepare an AIF is to potentially qualify to file a short-form prospectus as opposed to a long-form prospectus in the event they wish to raise public equity during the year. The AIF disclosure requirement can be found at Part 6 of National Instrument 51102, and the AIF must be prepared in accordance with Form 51102F2. So some considerations in preparing for annual filings. First, as we discussed at length in the prior section, focus on material information. Second, use plain language. Write it so readers are able to understand it. If technical terms are used, explain them in a clear and concise manner. See Section 1.5 of 51102 CP, the companion policy, for some plain language principles. Regarding filing of the required continuous disclosure documents we discussed, there are a few things to be mindful of. Corporate finance participation fees are set out at Part 2 of OSC Rule 13502 fees. As set out at Section 2.3 of the fees rule, a reporting issuer must pay the participation fee required by the earlier of the date on which its annual financial statements for its previous financial year are required to be filed under Ontario securities law, and the date on which its annual financial statements for its previous financial year end are filed. At the time a reporting issuer pays the participation fee, it is required to fill out the appropriate form as specified at Section 2.6 of the fees rule. This form must contain a certification signed by an officer of the reporting issuer. Money companies pay fees but do not submit the appropriate fee form to show the calculation of the capitalization. Late fees may apply. A reporting issuer that is late in paying a participation fee must pay an additional late fee of 0.1% of the unpaid portion of the participation fee for each business day on which any portion of the participation fee was due and unpaid. This is set out at Section 2.7 of the fees rule. There are also additional fees for late document filings, which includes late filing of the annual financial statements, AIF, or participation fee calculation form. The fee for each late form or document is $100 for every business day following the date the form or document was required to be filed, subject to a maximum either $10,000 or $5,000, depending on the issuer's estimated specified Ontario revenues for the previous financial year. Issuers are generally required to file their documents in the SEDAR system. Companies must keep their SEDAR profile up to date. We encourage you to sign up for the SME Institute session on February 22nd, 2018 on procedural matters and preparing for annual filings. This seminar will review common administrative and procedural filing issues and errors made by reporting issuers. OSC staff will discuss how to avoid certain common errors in the context of prospectus applications, continuous disclosure, and exempt market filings. So that concludes the main topics for today's presentation. Before we proceed to the Q&A, I'd like to draw your attention to the appendix in our slide deck, which contains useful references relating to today's topics, as well as general contact information and contact information for today's presenters. So thank you very much for joining us, and please stay online for the Q&A, which will begin shortly.